2024 tax brackets, what you need to know. Let's talk about it. My name is Corey Hulstein. I am a CPA and Director of Tax at Modern Wealth Management. Today we're going to be talking about the 2024 tax brackets and how they've changed from 2023. The tax code is set up in a way that mimics what inflation is doing to the economy in a way that it scales the tax brackets up accordingly. So if we think back to 2022 and 2023, we've seen inflation running hot. Therefore, we're going to see our tax brackets move accordingly. So for 2024, you're going to see a 5.4% increase to the tax brackets. What does that mean for everyday Americans? What that means is the lower tax brackets are going to expand by the 5.4%. Therefore, the 10% bracket in 2024 has increased from $22,000 for a married couple up to $23,200. Not the biggest movement in the world, but we can see these movements bigger on the 12 and 22% brackets as well. The 12% bracket for a married filing joint couple is now up to $94,300 as opposed to $89,450. You will also see the standard deduction increase as well. The standard deduction for a married couple is now up to $29,200 for 2024 as opposed to $27,700 in 2023. For our single filers, these brackets are essentially cut in half. We also see this bracket movement happening within the capital gains as well. The 0% capital gain rate has moved up to $94,050, up from $89,250 in 2023. We will also see some inflation adjustments related to IRA contributions. Both the IRA and Roth contribution limits are now up to $7,000 in 2024, up from their number of $6,500 in 2023. We will see this effect through other items like HSA contributions as well. If you remember, our good friend IRMAA stands for Income-Related Medicare Annual Adjustment. What this means is your income can be a little bit higher in 2024 relative to 2023 and not fall subject to the additional Medicare tax. We are going to see this number up to $206,000 in 2024 before we start being affected, as opposed to $194,000 in 2023. What does this mean for everyday Americans? If you are a working American today, if you received a 5% increase in your wages, your tax situation is likely unaffected because of the rate movements happening today. Additionally, the contribution limits for making IRA contributions has gone up as well. So all of these items are scaling according to the 5.4% inflation adjustment. However, it is worth noting that not all items within the tax code scale with inflation. Certain items like the child tax credit, residential energy credits, and other items are not going to be adjusted accordingly. So one thing to remember is for people with children, your taxes may go up slightly if you received that income, but your credits will not scale up accordingly as well. The last item worth noting as well with the inflation adjustments is the Social Security wage base. For our families who are high income earners, we did see the Social Security wage base also increase. What this means is we need to have Social Security withholding on our wages up until $168,600. This number has increased from 2023 from $160,200. Therefore, you will see a bump in the amount of tax you are paying towards the Social Security Administration. One other note for 2024, we've seen a lot of changes to the Beneficiary IRA rules over the last 4 years. In 2020, the Secure Act was launched, which means that any inherited IRA account needs to be drained within 10 years. There are complicated rules about whether an RMD needs to be taken on any given year. The IRS has recently come out and stated that they are going to waive that RMD again in 2024. We've seen this waiver happen over the last few years as people are still trying to figure out the new rules that the IRS has established related to RMDs on beneficiary accounts. We do anticipate that 2024 is going to be the last year of the waiver, but we will keep you informed on what the IRS continues to do with these accounts. Remember, for a beneficiary IRA, we still need to meet the 10-year rule. If an account was inherited in the year of 2020, the account needs to be fully drained by the year of 2031. If we have been postponing the RMDs on our beneficiary accounts, you can expect to take larger distributions as you approach the end of the 10-year window. Lastly, as a bit of a sidebar, remember that we are approaching the end of the Tax Cuts and Jobs Act. We are expecting to see a significant change in tax law happening in 2026. Make sure you're consulting with your financial planner and your tax advisor on what are the appropriate moves that need to happen in 2024 and 2025 before we see the Tax Cuts and Jobs Act expire. There has been a lot of speculation lately that we are going to see the sunset happen at the end of 2025, so it's important that we prepare and that we establish the accounts in a way that makes sense for us from a long-term perspective. Thanks for watching this video. As a quick recap, today we discussed how the tax rates have moved due to inflation adjustments within the code. Additionally, we have mentioned that the IRS has recently come out and waived the beneficiary IRAs, RMDs, for 2024. Lastly, remember that the Tax Cuts and Jobs Act is set to expire at the end of 2025. Consult with your financial and tax professionals to make sure that they're positioning you in the best way possible in years 2024 and 2025 before we see the sunset of the Tax Cuts and Jobs Act. Thanks again for watching this video. My name is Corey Hulstein, CPA, Director of Tax at Modern Wealth Management. If you have any questions related to the information in this video, feel free to reach out to us at any time. If you like this video, please like, subscribe, and share it with your friends.